Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in and take a look, see what's going on today. And if you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive deeper into all these different sectors, looking for investment opportunities and sharing them with everybody in the community. Special is the coupon code for the monthly membership. Type that in, get a 50% discount on the first month only. Ends up being $25 for that first month to try out the membership. If you like it, you can always switch to the yearly membership whenever you like, or go directly into the yearly if you want to do it that way. There's a discount there, 500 YR. It is a $100 discount, ends up being $500 for the year. So yeah, I was looking around and I don't know. I like doing ratio charts. I'm kind of a ratio guy. Um, Everything in life is based off of a ratio. So you go to the store, you buy beans, like green beans in a can. You pay dollars per ounce for green beans. Or you could say that it's the commodity like oil, it's oil in dollars. So it's oil priced in dollars, oil priced in gold, oil priced in Swiss francs. You catch my drift, right? Everything's a ratio. So a lot of the things able to see the cycle, you can put a hard asset versus a financial asset. Two of the opposites are energy and a financial asset like the NASDAQ Composite Index, IXIC. You can see the cycle through this, the top of the cycle, the shoulder, head, shoulder, and the bottom of the cycle, which is a double bottom that's starting to head higher. We're doing a retest on the right-hand side here, and I was just messing around. I had XLE up. This is XOP. There's the cycle looking at it from that perspective. And we're at the bottom of the cycle putting in a bottoming pattern. Very nice, clean cycle going through. And you can see on the right-hand side, if we zoom in, we're doing a retest. So this is the pattern here. This is your squeeze up. This is your breakout. This is your retest. And then usually you'll get a higher low, or maybe it comes back. And then we work our way on up. And that is in a larger, bigger picture cycle. You can see the bigger cycle there and what it looks like. So top of the cycle was 2008. Bottom of the cycle was 2020, 2021. And we're doing a double bottom here just recently in this particular ratio. That doesn't mean that the equities are bottoming and are super cheap. They bottomed down here in 2020. All the equities did. They popped up. And again, this is a ratio where NASDAQ had outperformed XOP for a little bit here. But I think we're good to go at any point here soon. Soon. So that's one of the ratios there. There's obviously other ratios that we can do. XLE was the ratio that was presented there. You can see the cycle, the shoulder, head, shoulder, topping of the cycle. This is when hard assets were expensive to financial assets on a ratio perspective. Now we are super cheap. So the cycle continues. And I know people want things to happen really fast. I get it. They want to get rich fast. But the quickest way is to ride one of these big cycles, either that cycle up. So this would be a cycle you want to ride. This would be a cycle you want to ride. And then we are turning, and we want to ride this cycle that's coming, where XLE, the energy sector, will outperform financial assets. And that's the cycle I play. That's my investment. So hard assets, financial assets, hard assets. It's that simple. And then you just sit and don't do anything. Make a bunch of money. Coming down, it says foreign government ownership of U.S. Treasuries just reached the lowest share in history. The world isn't keeping up with America's exploding debt issuance. That may prove to be one of the most important monetary shifts of our time. None of us own enough hard assets. And again, foreign holdings of US treasuries by government entities down, 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 down. What does that mean? Well, someone else needs to buy it because they're not buying it. Maybe it goes on the Federal Reserve balance sheet. I don't know. So it says US says it's monitoring oil markets for price fixing, says CBS. And then Kelvin says, are they investigating themselves? Yeah, this is where the weird thing is. If there is price fixing going on, how would you monitor it? I mean, the insiders who do the monitoring are the people who are fixing the price. So are they investigating themselves? Yeah, they're not going to find anything. And I mean, even if they do, they'll just blame it on something else. Not going to blame it on themselves. So I thought that was interesting, but I don't think it means anything. Here's another one. Lynn Alden. We're living through a slow financial collapse. Most people don't know it, but they can feel it. People kind of look around and say, why does it seem like everything's more expensive? I'm still earning money, but it just doesn't feel like it goes as far. And a lot of the times they're right. The money supply has been quietly debasing wages and savings in the background for decades. I totally agree with that. You know, I would say the change occurred in 2020 when they printed all that money. Ever since then, I feel like everything is like you're running uphill. Like you go to the store and you're like, God, I used to buy this like, 50% cheaper or 60% cheaper than I did, some years ago. Like pistachios are going through the roof. I don't know. I like pistachios and I'm just like, man, these things are just ripping. Beef is ripped. Eggs have gone up quite a bit. They did go way up, and I think they pulled back for most people, but the stuff when I buy it, it's up. I used to buy things that were like $3 and now they're $6 plus. Most other things too that I buy, they're up a little bit, maybe not as much as those. And then all the other stuff has gone way up, like couches and paints and stuff like that. So I'm gonna have to get some. I think the next thing I need to buy, I need to buy some window shades. I have one that broke, and I bet you that's super expensive. I haven't looked, but I bet you those are just. I need to buy. I'm gonna buy two of them because there's one on the upper and one in the lower. It's like, well, if I'm gonna replace one, I might as well do both. Coming down, Stephen, with a last name that I cannot pronounce. Says Japan sharply reduced gas-fired power output last month, instead relying a bit more on coal. Disruptions around Hormuz continues to choke LNG flows from the region. Asian LNG spot prices are 70% higher than pre-war levels. So Japan's utilities are turning to alternatives. This is what it looks like, gas power generation for 2026. Look at that divergence there. So it was coming on up, and then somewhere around, I'd say May or June, we had a pretty big move where it's not coming back up. And then we can see a little bit of a sharper upside move in demand for coal that started back in April. You can kind of see that's heading a little bit higher faster, and this one's kind of rolling over a little bit. So coal is substituting LNG for at least Japan here. Philip says U.S. plan in Iran is something like this: strike deal, we'll leave the funeral alone. You allow a few ships to trickle out of the strait. Hammer energy prices through media algo manipulation and SPR dumps. Pray it puts a little pressure on pump prices before November. That's the plan, boys. That's what they're doing. Be patient on energy. It'll come around. We've got that big cycle up here. Don't get too bearish, guys. Stay bullish. Relax. It's coming. It's putting in that bottoming. We're doing that retest. Give it some time. It looks good from a chart technical perspective. Roberto says, I don't know if most people understand what's beginning, but the biggest commodity supercycle of our generation might have just started. And these movements don't appear every year. They appear once every several decades. It happened during the Industrial Revolution. It happened after World War II. It happened with China's urbanization in the late 1990s. And now artificial intelligence might be igniting the next one. While most people keep eyeing tech stocks after huge gains in recent years, big capital has already started rotating elsewhere. Mining, energy, agriculture, commodities, and that's where I've rotated to since 2020. Because the problem isn't demand anymore, the problem is that there is not enough supply. The data centers that big corporations plan to build require massive amounts of copper, uranium, energy, and basic resources. And the market isn't prepared for that. For more than 15 years, there was almost no investment in mines, refineries, or energy infrastructure due to regulations, costs, and lack of incentives. And in commodities, when supply falls short, prices don't rise linearly, they explode. A copper mine can take more than 10 years to come into production. That imbalance doesn't correct quickly. That's why many believe we're entering a phase similar to the other major historical cycles where commodities end up vastly outperforming stocks for years. And we're not even talking about the food sector yet. Fertilizers have already started skyrocketing. Pressure on food keeps growing. And several international organizations are already warning of potential severe tensions for this decade. The question is, do we keep chasing stocks after years of gains, or do we start looking at commodities before everyone else? No, you want to start looking before everyone else. You can also reduce risk. If things are very expensive in those other sectors, you can reduce risk. So a lot of people will say, well, let's say two assets go up the same amount. And they'll say, well, they went up the same amount, no big deal. It's like time out. Sometimes you can take a very low risk asset and make a lot of money versus a high risk asset that can make the same amount of money during a certain market condition. The better asset, even though they had similar returns, would have been investing in the lower risk asset to get that return. And maybe risk is measured by the downside risk. So a lot of people, I hear this all the time. They'll make a comment like, well, this stock went up, stock A went up more than stock B. And it's like, yes, but stock A was super, super risky. You could have gotten cut in half in a blink of an eye. Just because it went up a 2x and this one went up, let's just call it 1.75x, it doesn't mean that you made the right decision. Because what you're doing as an investor is you're investing in assets over and over and over and over time. And what you want to do is you want to reduce risk, get a pretty high probability of success, and get as much as you can out of that investment. So it is at times, sometimes okay to give a little bit of upside and protect the downside. And that would be a better play every single time. Because if let's say the downside outcome, if something bad were to happen, maybe one asset would go down 80%, and the one that you were in maybe only goes down 10%. So you give a little bit of upside for downside protection. And just because there's an outcome doesn't mean that if you chose a certain decision and it wasn't the greater return, it doesn't mean that you made a bad decision. Because over time, you're making these decisions, and sometimes you want to choose in certain market conditions a little bit less risky option versus something that could be incredibly risky. Now, this one here, it says super commodity cycle. We are facing the biggest commodity super cycle of our generation, and the market is focused on something else. He says the world is trying to do everything at once: rearm armies, build the data centers that AI needs, electrify the grid, electric cars, factories, and accelerate the energy transition. And all of that requires copper, lithium, rare earths, critical metals, etc., in quantities that the market cannot produce. Copper and silver don't get printed. And of course, on top of all of this, add one of the biggest eras of monetary devaluation in the history of fiat currency and fiscal deficits. Supply deficits, fiscal deficits, you have to be blind not to see it. And again, this is the chart here of US commodity price index 1795 to present, with major inflation peaks, red dots, and major inflation troughs, blue dots, the troughs. We are at a trough. And then this one, if you were to take the cycle, could do something like maybe we get a big move higher all the way up to 2045. That's kind of what this cycle would represent or project. So that's what we've got going on there. Coming down. Now, I read these things that Musk talks about. I'm just going to read it here. He says, listen up. These are Musk's 3 predictions for AI world 5 years from now. Just 5 years. He says, those degrees you're so proud of will be worth less than toilet paper within 3 years. The financial models, legal clauses, and medical diagnostics you spent 4 years learning. Robots will master them with a single glance. Going to medical school, don't bother. By 2030, the Optimus robot's surgical skills will surpass every top human surgeon on Earth. Humans will no longer be the smartest species on the planet. In 2031, the total sum of all digital intelligence worldwide will be greater than all human intelligence. Frantically, saving money now for retirement is utterly foolish in his opinion. Within 5 to 7 years, the global economy will double. The number of humanoid robots will exceed humans. They'll build houses, fix pipes, perform surgeries, drive trucks, and money will lose all meaning, becoming completely obsolete. Because whatever you want, robots can make it. Energy comes from the sun, materials from recycling. I don't know. I mean, is this really what the future is going to bring? I've read this before. And I don't know. I have it deep down inside of me. I'm like, I want this to happen. But is it actually going to happen? And I don't know. Like, I really do want this to happen. I mean, what does this mean for minerals? And then, of course, I'm an investor and I think, well, how can I invest to make money from this? And then in the back of your mind, you're like, well, Elon basically is saying that this is going to be so rapid and so big that money may even be obsoleted at some point. Maybe that's 7 years down the road. Man, I don't see if I knew this was 100% true, well then yeah, maybe I'd change my spending habits. But do you risk it? Mm, I'm not going to risk it. I'm going to still stay on the path of saving for quote retirement, but optimistically, I hope this happens. I hope that happens. It'd be pretty cool. Eyes on oil as it bounces off major levels of support, with the relative strength indicator sitting on significantly oversold territory. Since it has officially closed its gap, he's talking about this gap back here. A successful backtest and push back toward 84 is a high probability setup. So he thinks it's going to come back to like 84 or something like that. I don't know. We'll see. To me, it looks like it's trying to bottom and work its way on up. So I do think that is a possibility. And I don't think it looks that bad. Just Dario says, this is the chart that amazes me the most lately. 3-2-1 crude oil crack spreads not only continued to break new all-time highs, but at $58, the spread is just $10 away in absolute amount from 1 barrel of WTI crude at 69. Your crack spread is almost as big as a barrel of oil. Question 1. If oil refiners are supposedly printing money, if there was no tomorrow, while having access to ample supply of cheap crude oil. Why are the shares of oil refiners crack only up 6% since the 27th of February? Question 2. How can you have, according to this data point, a shortage of gasoline and diesel when refineries have been broadly running almost at 100% capacity around the world to replace the lost output from the Middle East without demand growing in the past 4 months? Well, I think some of that supply is not in the Middle East, it's in Russia for refining. I think that's where some of it is. Question 3 is, why aren't inventories being refilled now that the price of crude oil is back at pre-war levels and everything is back to normal? I don't know why it's not. There is some crazy things going on. It's like people say that we are in a glut based off of all the ships leaving the Strait of Hormuz kind of at once. Could be the case. So all I'm going to do is sit, wait, and see what happens to commercial inventory levels, because that's all that really matters. Right now, we are undervalued. So the value of oil should be higher than what it is today, but we'll see. We'll see what happens. I'll just sit and watch. Josh Young says the Economist admits defeat and is now bearish oil. The sound you're hearing is the few remaining oil bulls sighing in relief. Says we was wrong about oil, the market bested us, but for the Economist, there is no shame in that. I don't think it's over for oil. I think oil still has a great looking chart, and everything that I look at, it's just doing a back test. So these people are wrong about being wrong. Think about how wrong you have to be then. So they are wrong about being wrong about oil. Here's another one. It says, here's the problem. There are virtually no ships willing to sail to the Strait of Hormuz to go pick up that oil. As a result, tanks in the Middle East remain near full and production cannot be resumed. Traders are misunderstanding the Middle East aggressive discounts to lure buyers as a supply glut. This is Dubai physical premium at -4. Here is the problem. Middle East should be marketing September loading cargoes, not barrels for next week. So it looks like they're having problems with tankers coming back into the Middle East to load back up again. The chart of the day, this is labor force participation has completely collapsed. This is the warning sign right before unemployment surges. We'll see if unemployment surges. It could. We can look at unemploy. So here it is, the unemployment level. It's actually been going down here recently, not up. So it's going in the wrong direction in the short term, but we'll see what happens in the longer term. These are generally booms. If this were to pull back down, those are generally boom times. And oil does quite well during those time frames. The NASDAQ is 97.5% correlated to total global liquidity. It has almost nothing to do with earnings or how good the companies are, and everything to do with how much money the world's central banks are printing. The small slice that liquidity doesn't explain is the NASDAQ's own adoption curve sitting on top. This is why everyone keeps saying equities are expensive. They're using a measure that stopped working the moment we started debasing currency. A high valuation doesn't really tell you a company is doing well anymore. It tells you how much money has been printed. This is the heart of my everything code framework. Once you understand that liquidity is the key driver of all asset prices, the market stops behaving like a mystery and starts running like clockwork. What he's saying is the reason these equities are expensive is because money is being printed and then they put that printed money into assets. What I would counter with this data here that he is saying, oh, it's only this. So what I would counter with is we wouldn't be seeing this bottoming pattern if he was correct. It just isn't that. We are getting a rotation. And I think he will be wrong. The money will be printed, but it won't go into the NASDAQ. I think it will go into energy, precious metals, and we could do another one here. We can do, say, GDX divided by the NASDAQ. And this was your bottom. And there's the cycle. I put a kind of a cycle there. I think we're going to go all the way up to maybe 2030s, early to mid 2030s. And your cycle, this is the bottom of the cycle right here. And that bottom is a squeezing wedge. And we've broken out of that wedge. So in my opinion, although it may look like he is right, may look like he knows what he's doing, but if this continues higher, he's wrong. You want to be in precious metals like GDX or GDXJ or whatever instead of the Nasdaq. So we would see those running differently. We're in a commodity boom, and that's the justification are those ratio charts. But that's all I've got for today, guys. So we're going to end it there. Give me a thumb up to the content. Subscribe to the channel. Subscribe to the website if you'd like. We have a Sunday Q&A session coming up at 5 p.m. Mountain Time. So that's all I've got. We'll catch you later, guys. See ya.